Let me ask you a question. Why is it that some people work 12-hour shifts, save money for years, do everything they're supposed to do, yet somehow still feel like they're falling behind? Meanwhile, on the other hand, other people seem to be getting wealthier while they sleep. What if the answer isn't how hard you're working, but the type of money you're saving in your account? Because when you understand the difference between Bitcoin and the US dollar, you start seeing money completely different. Today, we're breaking down Bitcoin versus USD, how they're different, what they're designed to do, where each one wins, and why millions of people around the world continue to pay attention to Bitcoin. Let me ask you a question. If I gave you two forms of money, one that could be created forever, and one that there will only ever be 21 million of, which one would you choose? Most people answer that question in less than 3 seconds. Yet, most people have never taken the time to understand Bitcoin. So here we go. The US dollar can be created through monetary policy and the banking system. Bitcoin cannot. The dollar depends on trusted institutions. Bitcoin depends on verification through a decentralized network. The dollar dominates everyday commerce. Bitcoin was created to give people an alternative way to store and transfer value. So when people argue Bitcoin versus the dollar, they're usually asking the wrong question. The real question is, what happens when an unlimited asset competes against a limited one? That's why millions of people continue to pay attention to Bitcoin. Let's start with the US dollar. The US dollar has been around for generations. It's what Americans get paid in. It's what most bills are priced in. It's what many countries use for international trade. When you buy groceries, pay rent, buy a car, receive a check, chances are you're using dollars. And contrary, what many people believe, the US dollar is not backed by gold today. The United States left the gold standard in 1971. Today, the dollar is considered a fiat currency. Its value comes from the strength of the US economy, the government's ability to collect taxes, and the confidence people have in the system. Now let's compare that to Bitcoin. Bitcoin was created in 2009. It wasn't created by a government. It wasn't launched by a central bank. It was introduced by an anonymous creator known as Satoshi Nakamoto. And unlike the dollar, Bitcoin has a fixed supply. There will only ever be 21 million Bitcoin. That's the main reason people compare Bitcoin to gold. Not because it's shiny, not because you can hold it in your hand, but because scarcity matters. Think about it this way. If demand for something increases while supply remains fixed, the asset becomes more scarce. Bitcoin supporters believe that that's one of the most important features. Now let's talk about payments. If I want to send money using traditional banking systems, I might use ACH, wire transfers, Cash App, Venmo, Apple Pay, debit cards, credit cards. For the most part, these systems work very well, but behind the scenes, multiple institutions are involved. Banks, processors, payment networks, settlement systems, and there's usually a middleman somewhere. With Bitcoin, I can send value directly from my wallet to someone else's wallet. No bank relationship required, no business hours, no international boundaries, just a transaction recorded on the Bitcoin network. Now, that doesn't mean Bitcoin is free. Bitcoin transactions still require network fees, and depending on network activity, settlements times can vary. But the process is fundamentally different. Here's where things get interesting. Ownership. Most people think the money in their bank accounts belongs entirely to them. And legally, it does. But access to that money still depends on the banking system functioning correctly. Banks can freeze accounts under certain circumstances, fraud investigations, court orders, identity verification issues, compliance requirements. And most of the time, that's done for legitimate reasons. But it does highlight an important reality. You rely on a third party to access your money. Bitcoin offers a different model. If you hold your own Bitcoin in a self-custody wallet and control the private keys, you have access to those funds. No bank can freeze it. No company can lock you out. No customer service department can reset your account. But that freedom comes with a responsibility. If you lose your private keys or recovery phrase, there's usually no recovery process, no password reset, no help desk, no manager to call. The responsibility falls entirely on the owner. And that's the trade-off many people don't fully understand. On one side, the convenience and protection of traditional banking. On the other, the sovereignty and the responsibility of self-custody Bitcoin. Neither side is perfect. Each has advantages, each has disadvantages. So is Bitcoin better than the US dollar? That's not really the right question. The better question is, what role does each one play? The dollar remains the world's dominant currency for everyday transaction and global commerce. Bitcoin offers a new way to store and transfer value without relying on central authority. And whether Bitcoin becomes digital gold, a global monetary network, or something entirely different, one thing is certain. The conversation about money changed forever the moment Bitcoin was created. And that's why understanding both systems matter. If you enjoyed this video, subscribe, because in the next video, we're tackling one of the biggest criticisms of Bitcoin. If Bitcoin isn't backed by anything, why does it have value? That video will probably change the way you think about money forever. Peace.